Glad to have you join us again. Let's get talking now. The Monetary Policy Committee of the Central Bank of Nigeria has increased the benchmark interest rate, that's MPR, by 25 basis points to 18.75 basis points from its initial 18.5%, representing the highest interest rate in 22 years. The announcement was made by the acting CBN Governor Folashodun Shonubi during a press briefing after a two-day MPC meeting ended on Tuesday, the 25th of July 2023. This is the first MPC meeting chaired by the new acting CBN Governor following the suspension of Godwin Emefiele, and also the first MPC meeting under President Bola Tinubu's administration. Now, according to the MPC, the decision to further hike interest rate was driven by the rising rate of inflation in the country and all the macroeconomic fundamentals. Let's take a listen to the governor of the central bank.
Inflation across several advanced economies has continued to moderate, but remains considerably above their respective long-run objectives, even as monetary policy tightening progresses. In emerging markets and developing economies, inflationary pressure remains broadly elevated, though there are signs of moderation in some countries. Global inflation is thus expected to remain elevated through 2023, despite broad measures by several central banks to ease the pressure. In the global financial markets, financial conditions remain tight and may exacerbate further as monetary policy normalization progresses. Investors' preferences is thus shifting to advanced economy fixed income securities with improved yields as well as safe havens assets. The International Monetary Fund (IMF) in its July 2023 World Economic Outlook revised the 2023 output growth forecast for the global economy upwards to 3.2% from 2.8% in its April forecast. The improved output performance was due to the sustained resilience of the global economy to the prevailing headwinds in the first half of 2023. Global growth is, however, projected to moderate downwards to 3% in 2024. Domestic economic developments. Available output numbers from the National Bureau of Statistics, NBS, showed that real gross domestic product, GDP, grew by 2.31% year-on-year in the first quarter of 2023, as compared with 3.52% in the preceding quarter. While growth moderated, it has remained positive since Q4 2020. Thus, steady and positive performance was driven largely by sustained growth in the services and industry sectors, supported by broad-based measures by both the monetary and the fiscal authorities.
And there you have him, the acting governor of the Central Bank of Nigeria, Mr. Folashodun Shonubi. Joining me now live to give us more insight into key resolutions and deliberations made at the just concluded July MPC meeting is the chief economist at Zenith Bank Group, Mr. Marcel Okeke. Good morning, sir. Many thanks for joining us on the program.
Good morning to you. Let me correct your impression straight away. I'm no longer
the chief economist
of Zenith Bank, the former one.
Okay.
I am now the chief executive and lead consultant of Mascot Communications and Consult Limited.
All right, fact established. Let's get talking now. I'd like to know, what is your reaction to the development that played out at the two-day MPC meeting? Does the hike in interest rates come as a surprise to you, or it's quite expected?
Thank you very much. Well, yes, it's expected. It's expected because that's a key instrument. The monetary authorities, it can always apply in trying to tackle inflation that has assumed a runaway dimension in the past several months. So interest rate management is a key instrument for them to try to fight inflation. And that is why it's expected that they're going to move it up or down. But what they have done, they just move it up marginally. It's a marginal move. But the truth is that what they have done can in no way have any significant impact on inflation. Because as we speak, there are several factors that affect or push up inflation rate in the country. One of them is fuel subsidy removal. The second one is the merger of interest rate or naira flotation. Okay, so all these ones have been affecting or pushing up interest rate. Inflation rate. Okay, because if you talk about naira flotation, for example, manufacturers or anybody that has anything to import in the manufacturing or productive sector, you have to put together a lot of naira for you to import whatever you are importing, and that goes to push up your cost of production, and that cost of production, one way or the other, will be transferred to the ultimate consumers, and that will reflect as inflation. There's nothing anybody can do about it. Okay, that's on one hand. On the other hand, subsidy removal, of course, has shot up the price of PMS, by several 100%. And that is translated to high cost of production by all manufacturers or producers of whatever, and the cost of transportation. So when you factor all this into our everyday life, you see that inflation rates will keep soaring. As a matter of fact, although we have 22.79% in June, as given by National Bureau of Statistics, by the time the figures for July, comes out, we are looking at something more than around 25%. So it's not something a marginal increase in NPR can in any way stop or control. That's my initial reaction. Thank you.
All right, thank you for that insight. Still talking about inflation now. The Bank of America said that although they projected that Nigeria's inflation rate will shoot up to 25% this year, do you share in that sentiment? And if yes, what should be the responsibility of both the fiscal and monetary authority to cushion this effect on businesses and households?
Thank you. Really, the Bank of America you referred to projected 30%, not 25%. Projected 30% inflation rate for Nigeria by the end of this year, and is likely to get to that, given what is on ground now. What I can say, the monetary and fiscal authority should be doing to some extent, tamper with that, is to seriously face export drive of non-oil items, because as we speak, this economy is still a largely import-dependent economy. Okay, so if the powers that be now can seriously encourage export, and that export will be turning in a lot of foreign exchange, a lot of dollar, so that the exchange rate of the naira vis-a-vis the dollar and some other hard currencies will come down or stabilize. Because as we speak now, if nothing serious is done, it's likely that it's going to hit something close to 1,000, in a question of a couple of months. So, but if serious effort is made to increase export, and we experience improved inflow of foreign exchange into the economy, the exchange rate will come down, and so it means that importers will not have to have mountains, in quote, mountains of dollars, naira, for them to get some units of dollar to import. And so that will somehow be taming, their cost of production, and that will reflect in, their pricing.